One of the most important factors in any real estate loan is loan to value. So what exactly is loan to value? So loan to value, or LTV, is a ratio that represents the loan amount relevant to the value of the property that's been used as collateral. Different lenders will have different maximum LTVs. So for purchases, rate and term refinances, and cash out refinances. And they're also different between DSCR loans and hard money loans. So for example, you'll probably see a lot of time for purchases a max LTV of 80% on a DSCR loan. A rate and term refi would be 80% as well. And then a cash out refinance, usually 75%. So as I've talked about in other videos, these do vary between lenders, but this is quite common for what you see. Now, a property may not always qualify for that maximum LTV. If it's a DSCR loan, then the cash flow from the rental property needs to be high enough to cover the loan amount and the monthly expenses at the LTV that we're trying to reach. If it's a hard money loan, then things like the as-is value of the property, the purchase price, and the after repair value, if all those are applicable, they are all factors in determining what LTV the lender will offer, and it may not always be the maximum that they can offer. Now, to calculate your LTV on a DSCR loan, first obviously we need to understand what exactly the DSCR ratio is and how to calculate that. I did just shoot a video on that last week, so if you're interested and you want to check that out, just click the card above my head, go watch that, understand how to calculate the DSCR ratio itself, and then you can come back here and watch the rest of this LTV video. So as I mentioned already, and as I've talked about in other videos, each lender in the DSCR space has a different maximum LTV that they will go to for different types of transactions. For purchases and rate and term refinances, that's usually 80%, and for cash out refinances, that's usually 75%. You will see a lot of lenders do 70, but 75 is the most common. So for example, if the purchase price of a property is $400,000, so $400,000 purchase price, and let's say we want to do an 80% LTV, that is going to be a loan amount of $320,000. So that's your loan. That would mean that the borrower has a down payment of $80,000. Knowing how to calculate LTV and knowing how to play around with the numbers, so play around with different LTVs, play around with different DSCR ratios, is a really important skill that brokers in this space need to have if they want to be successful. They need to be able to offer their clients options and solutions to the types of loan requests that their investors have. And this is exactly what I teach in my program. I teach my students the importance of LTV, DSCR ratios, how to understand them, how to calculate them. I actually provide them with calculators that they can use and lots of other tools and resources that they need so they can be successful loan brokers in this space. I'll put a link below if you want to check it out and book a call with me to chat further about how I can help you be successful. Now, obviously maximum LTVs that lenders offer can be really frustrating for borrowers because borrowers, a lot of the time, want to put down as little money as possible out of their own pocket. So they want their down payment to be as low as possible. So that means they want their LTV to be as high as possible. But maximum LTVs and limits on LTVs can actually benefit investors too. If a property doesn't cash flow at the maximum LTV that a lender will offer, then it's probably not a good idea to buy the property. If you have to put more money down, so tie up more of your cash as equity in the property just to get the property to break even on cash flow so you can qualify for a loan, it's probably not the wisest investment strategy. So going back to our earlier example, if the rental income from the property is not high enough to cover a maximum LTV loan, so 80%, $320,000. Let's say the maximum LTV that we can get to is 62.5% is the maximum LTV we can get to. So that's going to be a $250,000 loan. So now we've got a $250,000 loan and a $400,000 purchase. So just to get the property to qualify for the loan, which is a break-even cash flow in this example, the borrower has to tie up an additional $70,000. So they're tying up $150,000 of their cash in the property just to get it to break even. As a broker in this space, it's important to be able to offer this analysis to your clients. And sometimes offering this analysis will result in you advising your client that this is not a good deal for them to get into, that they should not move forward with this loan. Now, obviously, a lot of brokers won't do that because all they care about is their commission on the deal. These brokers are the ones that will not make it long-term in the industry. What you need to do is put your client's needs ahead of your own needs. In the long run, it will pay dividends and you will be successful and you will make a lot of money. Now, another factor that will affect LTVs is the borrower's credit score. So I have talked in other videos about how DSCR loans are not based on the borrower's personal income. There's no proof of income. It's not based on their tax returns, their debt to income ratio, etc. But the one factor that does matter on the borrower's personal financial situation is their credit score. Credit score does affect loan to value. The lower their credit score, the higher the interest rate. And obviously, the higher the interest rate, the higher the monthly payment. So again, knowing the impact that the monthly payment has on the LTV you can qualify for, if the payment is higher, then that means your rental income may not cover that higher payment anymore, which means you can't qualify for a higher LTV. So credit score is an important part of the equation here for sure. I teach more about this topic and everything else that you need to be successful as a loan broker in the DSCR and hard money space in my training program. Check out the description below for the link.